All right. Thank you, everyone, for joining. Today, we're excited to present Powering Texas, the roadmap for structuring bankable TEF projects. My name is Winston Skinner. I'm a counsel in our energy regulatory group in the Austin office. And I am pleased to have with me today a few colleagues as well. From our Washington office, John Decker. He is a partner in our energy regulatory group as well. John represents companies and transactions and regulatory matters involving electric and gas energy infrastructure, including both at the Federal Energy Regulatory Commission and in front of the Department of Energy. Also with us today are Mark Brasher and Mark Holmes in Houston. Mark Brasher is the one on the left, and Mark Holmes is the one on the right. Mark Brasher represents investors, developers, and other participants in major energy infrastructure projects. He is a partner in our energy transactions and projects group in Houston. And Mark Holmes is a partner in our finance group in Houston. And Mark represents borrowers, lenders, and sponsors in a wide variety of energy and infrastructure financings. So thank you guys for joining today. One programming note, today we're focusing, as I mentioned, on roadmap for structuring bankable Texas Energy Fund projects. We have a follow-on presentation next week on Tuesday, the 15th, where we'll be discussing environmental permitting, specifically air quality permits, the process to obtain and defend those permits, both in Texas and with the EPA on the federal level. For those of you who are joining and have been neck deep in the Texas Energy Fund process, we appreciate you joining. There may be others here who are perhaps knee deep or even ankle deep in the Texas Energy Fund, and maybe a little bit of background is in order to get some of our guests up to speed on what this program is, where it currently stands, and most importantly, where we think it may be going. So just a little bit of history here. This is a novel state-funded program that came about through legislation in 2023. Texas passed Senate Bill 2627, which established the Texas Energy Fund, subject to voter approval through Proposition 7 in November of 2023. That constitutional amendment was passed by Texas voters, about 65% or so of the vote, and became law at that point. What is the Texas Energy Fund? It's really a series of 3 different programs that have been funded so far with a $5 billion appropriation. Today, we're focused on what we think is going to be the main one, which is loans to new dispatchable power generating facilities in the ERCOT region of Texas. There's a sort of a companion program, if you will, for those same types of facilities, which are completion bonus grants that are potentially available to projects that come online within a certain period of time. 2 other components of the program, which we won't be addressing today, but are important to know about, are the backup power package, so essentially funding for small scale, about 2.5 megawatt or less sites in Texas. And then third and finally are outside of ERCOT, but inside of Texas electric infrastructure facilities. Those can be both transmission, distribution, or generation projects that are available as well. As I mentioned, this program has currently $5 billion worth of funding that was appropriated by the Texas legislature in its last regular session. There has been substantial talk among major stakeholders that another $5 billion will be potentially appropriated in the upcoming 2025 legislative session. That, of course, remains to be finally determined in the future when that session opens in January. A few notes on the scope of the program. So again, we're talking here about the in ERCOT loan program for new dispatchable generating facilities. Those there are approximately 125 different projects that indicated initial interest in this program. When the application period closed in the end of July of this year, there were 72 project applicants. And recently, at the end of August, the Public Utility Commission of Texas voted to advance 17 projects, now 16 projects, to the due diligence phase, which applicants are currently undergoing as we speak. Those 16 projects total around 8.5 gigawatts of power and represent over $4 billion worth of potential loans out of the $5 billion currently appropriated to the Texas Energy Fund. So that's where we've been. Where are we going now? What to expect as the process unfolds. And really for that, we may be able to look to clues in a potentially analogous government program, which is the Department of Energy loan program that has been ongoing for a number of years. Now, of course, this is a Texas program under Texas law, so I would certainly be remiss if I didn't have a little Texas rah-rah in here. Full caveat, the Texas likes to chart its own course and certainly likes to distinguish itself from the feds whenever possible. So it is entirely plausible that some of the features of the Department of Energy loan program will be a point of contrast from the Texas Energy Fund as much as a point of comparison. But I think, as you'll see, as Mr. Decker and I discuss here in a moment, there are some similarities between both programs, and it will remain to be seen how similarly Texas chooses to structure its loans and really pursue the loan diligence process in the way that the Department of Energy has. So given the nascence of the Texas Energy Fund program, let's at least explore a little bit of the Department of Energy loan program. So let me bring in now my colleague, Mr. John Decker. John, how are you today?
I'm good, Winston. Thank you. And by way of introduction, if you're familiar with the DOE loan program, you know that currently DOE is focused on innovative technologies that have the potential to reduce greenhouse gas emissions. However, from 2009 to 2011, at the beginning of the Obama administration, they had a temporary program that was aimed at power plants using commercial technology. So in this discussion, I'm going to be referring sometimes to the current loan terms and current DOE policies, but also I'll be referring back to that program for comparisons to power plants.
If we can go to the next slides, please, slide 5. Perfect. So, John, maybe just at a high level, why don't you walk us through some of the general terms of the DOE loans, especially under that temporary program that you mentioned? Yeah. Generally, size, maturity date, interest rate, things of that nature.
Right. So in terms of size, the statute allows DOE to lend up to 80% of the eligible project costs. However, in practice, it's been about 55 to 60% of the eligible project costs. And then maturities vary considerably depending on project, but they can be as long as 20 years. And the interest rate, interestingly, is there's a different interest rate established for each draw, and it's based on the current Treasury interest rate for a T-bill of the same maturity as the loan payback period.
And that really compares, I think, somewhat nicely with the Texas Energy Fund general terms that are laid out in the statute. Approximately 60% of the estimated project costs are the maximum amount that the TEF can loan, fixed rate of 3% interest, and a 20-year period. John, what about collateral and security obligations on the part of the borrower?
So the collateral requirements are pretty heavy. DOE requires collateral, of course, over the equity of the borrower in all of the assets of the borrower and its subsidiaries. DOE security must be at least pari passu with any other debt, and in practice is typically first priority.
And again, I think that provides, again, a pretty nice point of comparison. The Texas Energy Fund program requires that the TEF be the senior secured first lien debt on the property. And Mr. Holmes will be addressing some of that in his part of this program coming up here in a bit. John, what about equity contributions from the sponsor? What can we expect there from the DOE?
So this is a real difference between a private loan. For a DOE loan, all of the equity has to come in first before the loan is drawn on. And then the draws proceed to a pre-established schedule.
And that's really one point of really an open item in terms of the Texas Energy Fund, whether or not the administrator, who's Deloitte in this case, will be requiring equity funded all up front or in some other phasing as loan drawdowns occur. John, what about reserves? What does the DOE require here on reserves?
They're burdensome to the substantial reserve requirements to de-risk the construction and operation periods of a project.
And there's really a slightly different version in the Texas Energy Fund. We've got a 3% escrow that the project sponsor needs to post upfront upon receiving the loan until that project enters service, and it's really to secure the timely completion of the project. So we've got a little bit of a difference there. John, in terms of the negotiation process, generally speaking, why don't you just walk us through who the Department of Energy uses as consultants and counsel and so forth? What does that process kind of look like behind the curtain?
So DOE has retained nationally recognized counsel and consultants with a lot of experience in project financing. The good news is it's very professional. They can move pretty quickly. It's not like you're dealing with the government bureaucracy. At the same time, because of the need to negotiate across many parties at once, they have their own forms, and those forms govern. And even when we try to make changes that we think are reasonable or would conform to what the private sector would do, the answer is often, look, this is DOE policy. And so the answer is no, and that's whether or not the particular subject is addressed in DOE's regulations or not.
Yeah, and that's, I think, where a substantial portion of the uncertainty on the Texas Energy Fund process really lies at this point. As I mentioned earlier, Deloitte has been hired as the administrator and essentially the financial advisor for the Public Utility Commission of Texas to administer this program. As of yet, as far as we know, no outside counsel has yet been hired to assist the TEF in this process. And so as the kickoff meetings occur, and we'll get to that here in a minute, with Deloitte and all of the project applicants who advance to the due diligence stage, that'll certainly be one item to keep a sharp eye out for. John, moving on to the process, just walk us through a little bit the different stages of the DOE loan process.
Sure. Yeah, you have 3 stages to the process. There's sort of what we call the pre-term sheet phase. The applicant submits a detailed financial model, business and construction plans, rating agency assessment, third-party independent engineer reports, and DOE examines all that documentation before making a decision to move to the term sheet phase. So if DOE decides that it's a good project and they want to move to the term sheet phase, then at that point the applicant provides all of the contracts related to the project. And I'll note here, for the temporary program, if you remember President Obama's phrase that he was looking for shovel-ready projects. So that really meant you had to have your PPA lined up, your interconnection agreement lined up. There wasn't time to go through a 2-year interconnection process in the context of the temporary program. That, and then at the same time, you're negotiating a very detailed, 60-page term sheet with DOE, and that takes, all told, about 6 months. That's the longest part of the process. And then once you get to the end of the term sheet phase and DOE is satisfied with their diligence, they make a conditional commitment. Before then, you have to get sign-offs from the Secretary of Energy, Office of Management and Budget, DOE's Credit Review Board, so there's a lot of internal approvals. And then once they make the conditional commitment, they can move to closing in 1 or 2 months if things go very smoothly.
And so that provides a bit of a contrast, I think, with the Texas Energy Fund process we've seen currently. So the TEF really is looking for a wide variety of projects at different points in the interconnection process and the development process. Certainly some projects that are a little bit earlier in development. Many of them have just entered the interconnection queue with ERCOT. So some of them are certainly closer to shovel ready, but I don't think any of them have fully advanced and fully executed contracts in place yet. So an interesting difference there. Let's talk a little bit about a couple of key features of how DOE looked at its loans versus how the TEF is, or at least maybe looking at their loans. And let's start with revenue projections. Of course, any lender is going to be very interested in solidifying where those revenues are going to come from for a project. How were the DOE projects in terms of their revenue projections and particularly their offtake contracts?
Yeah, I mean, so that program, pretty much all of them had long-term PPAs with investor-owned utilities or municipal utilities, but they were all locked down with long-term PPAs. So then you could build a financial model based on the pricing contained in the PPA.
Right. So they're a bit of a contrast to at least some of the current TEF projects, which are, many of them are expected to either not be fully contracted or perhaps not contracted at all. A little bit of difference there for the ERCOT market versus some other markets where, fully integrated utilities remain. And I think it will be really interesting to get feedback from both the Public Utility Commission and the TEF staff and Deloitte, the administrator, in terms of how much they really want to see fully contracted offtake. They've got a little bit of an issue in terms of balancing reliability and load serving considerations, and we'll get to that here in a minute. So, John, you mentioned earlier that all of the customers for the DOE loan recipients were traditional utilities. In terms of whether those projects were co-located with any particular loads or private use networks, any insights into those aspects of the DOE program?
Well, the program existed before the current revolution in co-location. I think the answer might be different today, but it just wasn't a topic back then.
And in terms of geographic and sort of grid topology considerations, what level of review was the DOE really doing in looking at those items?
So they were very concerned about deliverability. So, for example, if you had a project in Oregon that was delivering to a utility in California, DOE would take a very close look, both contractually and technically, at say, constraints that existed around the California-Oregon border that might threaten the revenue of the project and upset the financial model.
I think that really serves nicely to highlight some of the challenges that the Texas Energy Fund is going to be faced with. By law, the projects here cannot primarily serve industrial co-located load or private use networks. And the PUC, of course, has been, very focused on reliability and relieving grid constraints. Because some of these projects are in the early phases of the interconnection queue process, the results of those interconnection studies will obviously be of paramount importance going forward to ensure that these projects can actually deliver the benefits that the TEF envisions here. So John, thank you for highlighting some of the aspects of the DOE loan program. Again, it will remain to be seen whether it really serves as a point of comparison or as a point of contrast with the Texas Energy Loan Fund program going forward. But we can certainly draw upon that and use that as a lens through which to view some of the moves that we'll see from the TEF administrator going forward. So thank you for that. Now, I think it'll be helpful to understand some of the commercial and developmental strategies. And here to talk us through some of those issues is my colleague from Houston, Mark Brasher. So Mark, take it away and let's get the next slide, please.
Thanks, Winston. And if we can go to the next slide, please. So I'm going to talk a bit about the suite of project development and construction agreements that applicants are likely working on right now. I'm cognizant of the fact that some applicants may actually have signed some of these agreements. So I don't want you to have a heart attack when I tell you that something is required or best practice. The process which we've been through with DOE and in other government-funded projects is a fluid one, and I think what's important for loan applicants is understanding the issues in your key project development agreements and anticipating some of the questions that are going to come up in the due diligence process and having answers and narratives that allow you to get through those. So I think as we identify issues and you do that in considering your suite of development agreements, you need to think about whether is that something we renegotiate or we negotiate with the counterparty, and what's the cost of that, or is it something we can address otherwise in the diligence process. So with that in mind, I want to firstly address the construction agreements, and I've sort of bundled EPC arrangements with O&M because when thinking about gas-fired power plants and 20-year loan terms, it's just as important to think about the contractual arrangements that you have during the operating phase as it is for construction. One of the things that we're seeing in the EPC market right now is that there's a proverbial gold rush in power, and it's drawing a lot of new participants to the market, and a lot of contractors without a huge track record of performance are starting to appear, talk to some of our clients, and put themselves between the customers and the original equipment manufacturers. And that can be a problem. As some of you will have looked at, there are comprehensive due diligence request lists already having been released by the PUC. Counterparty credit is an issue. That letters of credit and ability to provide them is an issue. And just generally performance, the ability to perform. And in the large power projects we work on, we're always hyper-focused on having recourse against the OEMs, the ones who have the balance sheets and the wherewithal to meet performance, warranty, schedule requirements, and the remedies that might be associated with issues that come up if there is a major incident. So I just want to talk about a couple of those things, and you can address them either through lump sum turnkey contracts or through alternative procurement methods that include robust agreements with the OEMs. So performance guarantees, this is certainly an issue in the program. As many of you will be aware, the rules require a performance covenant to be given by the borrowers, which guarantees availability over the full 20 years of the term. Some of the details around the edges of that covenant are yet to be fleshed out, and Mark's going to talk a little bit about how you can be proactive about that in dealing with during the term sheet phase. But we know more or less where we're going to end up on the performance covenant, and you need to be thinking about aligning the performance guarantees under the EPC contract, capacity guarantees, heat rate, and all of that stuff, and then rolling into the operating phase, aligning your LTSA arrangements with that covenant and trying to have some coverage from the OEMs that's going to give you a story to tell on that issue if it comes up. Now, one thing some of you, I know that, I've seen some of the projects involve refurbished equipment or used equipment, and you might be sitting there thinking, well, how do we satisfy this requirement if we're using refurbished equipment? And that, I think that's, if you're in that situation, it is a case of having to develop your narrative and what are your other contingencies, what are the reserve requirements that are going to be imposed on you if you don't have performance guarantees from creditworthy counterparties, and have you planned for those? And we've been, there's a lot of refurbished equipment washing around the market right now, so we've dealt with these issues in other contexts and have various ways to address them depending on the technology. So moving on to the operating phase agreement, so I think we've talked a little bit about guarantees and warranties. You should be exploring with your contractors or the OEMs what is available in terms of long-term service agreement coverage. The OEMs, most of them offer fairly premium LTSA terms if you're willing to pay for them, that include availability guarantees around response times. Sometimes when you're dealing with fleets of smaller turbines or engines, you can negotiate terms regarding standby or replacement engines and the time that it takes to get one of them in place if you do lose some capacity. So I would be thinking about those issues and talking to your construction and operating phase counterparties about them. The other thing that a long-term service agreement can provide you is some price stability for your model. Obviously, that's going to be scrutinised during the due diligence phase, and the devil is certainly in the detail around the pricing of these types of agreements, and so you need to understand exactly what the dials are that can affect price over the term of long-term service agreements and other agreements that are underpinning the cost element of your operating phase budget and model. Okay, so to the next slide, please. So I've just listed here the other key development agreements that parties need to be thinking about and negotiating if they're necessary. And we know from past processes and the diligence list that the PUC's released what they're going to be looking at in these agreements, and what you need to be thinking about. So as I mentioned before, counterparty risk is a big issue, and I'll address that in more detail on the next slide. But you really need to be thinking about who you're contracting with, what's their credit, and are you able to keep them on the hook for the period of time that you need them. One thing I would recommend, given how many agreements all come together to create one of these projects, is having a matrix of risks and obligations and making sure that they're consistently addressed across the agreements. The worst nightmare of a project owner or developer is to find that they have to perform under one contract and thought that another party was going to be able to meet that obligation for them, and they can't. So dealing with those interface issues is critical, and being organised about how you address them through the process, it will be important. Similar for dispute resolution, the more you can align those terms, the better place you're going to be if something goes wrong, and you just, that is not an issue in the diligence if you've thought about it and addressed it up front. I think everyone should be thinking about regulatory compliance and changing law risk given the current environment that we're in, and the fact that this is a gas-fired power plant program. So there is potential in the future for change of law to affect the economics on this project, or even the ability to operate, and so understanding those risks, anticipating them, and then trying to address them by placing levers in these agreements is important, and a way that you can kind of future-proof your project. So if it became either beneficial to add carbon capture or hydrogen blending or fuel switching in the future, can you actually do that? Have you signed up to agreements on transportation or gas supply, or with your contractors that give you the flexibility to kind of turn the dial on those obligations and adjust and pursue a different track or supplement what you're doing on the project. So I would be thinking in all of these contracts about changing law, how it affects you, and how you can give yourself flexibility, and also how changing law might affect your counterparties and any surprises that it could trigger, coming from them. So what are their rights if there's a change in law that affects their business, and could that cascade into your agreement and cause an issue? Okay, to the next slide, please. So as I mentioned, due diligence list, we've seen from previous processes, counterparties matter. If you're doing a lump sum turnkey EPC, is the contractor robust? We've seen quite a few EPC contractor bankruptcies over the last few years. It's certainly an issue that advisors to the PUC are going to be cognizant of, and they're going to be looking at that, particularly when your answer on the construction risk allocation is we've got a lump sum turnkey EPC contract. Again, I mentioned this before, but just beware of some of these intermediaries who are in the market and probably can't satisfy credit requirements particularly for the larger projects under this program. And you want to make sure you're not in a position where you're trapped with one of them without recourse to the OEMs themselves, or ideally a better counterparty if you're doing lump sum. Credit support, there are numerous questions in the diligence checklist about credit support. Interestingly, there's a question about performance bonds. In the typical project finance world, people prefer letters of credit. Most of our sponsor clients prefer letters of credit to secure EPC contractor performance. But we're in an environment right now where letter of credit capacity is stretched, and all of the contractors are complaining about this, trying to avoid putting up typical LCs and LC, and trying to avoid the size of LC that's typically required in project finance deals. So it's interesting to see that bonding's mentioned, and to the extent that contractors are proposing performance and payment bonds instead of letters of credit, that's something to explore and potentially get in front of the PUC to feel it out early in the diligence process to see whether it would be acceptable. Termination rights I've discussed, and then lastly transfer restrictions. Your counterparties are important, and so just as important who you're signing up with is making sure they will remain there, and so you want always be checking your assignment provisions, change of control clauses in these contracts to make sure that who you're contracting with now will be who you have the contract with in the future. It just generally, all of these agreements should include financing cooperation language, and you should be thinking about how to mitigate some of the challenges that will come up during the due diligence process. In Texas, we have various lien laws, including lien rights under the Texas Constitution that contractors can potentially rely on. You will have contractors performing work right now that could potentially create lien rights. So it's really important to be thinking about how you're going to provide first priority lien rights on all of the project assets to the lender and avoid having an issue with an early contractor when it comes time to close the loan. In our financing cooperation provisions, we have general language around agreeing to amendments to these contracts to satisfy lender requirements, so that there is that back and forth whether you've signed the contract or not, and you have the ability to adjust terms late in the piece if you need to. All of these counterparties should be expecting to be asked to execute direct agreements. So make sure people are prepared for that. So with that, I'll pass on to Mark, who's going to address the loan requirements.
Thanks, Mark. So next slide. Next slide, please. All right, there we are. So my portion of the presentation is going to be geared more towards the selected applicants who are currently in the due diligence process, but also the applicants that were not selected and who may be looking to fill the 1,500 megawatt gap. I mean, one of the things that came out of the advisory committee meeting yesterday was that the commission is going to look to the loan program, likely in combination with the grant program, to fill that gap. So if you are one of those projects that was not selected, there still may be an opportunity there to pursue that project under the loan program. Bit of a disclaimer, this is a bit subjective and speculative. Project finance, especially early stage, is very fluid. It's very dynamic. While there are some questions answered around the program, there are a lot of unanswered questions as well. The purpose of my portion of the discussion is to really help you ask the questions and answer, where are you now on your project? Where should you be, and what should you be doing moving forward as you work towards getting your project to execution? One of the key takeaways here is that I would view due diligence in terms of the loan program and its administration as a two-way street. The applicants are going to be undergoing a due diligence process from the administrator, and I think it's fair for the applicants to have their own set of diligence questions in terms of how the loan process works, what the final terms will look like. That will flush itself out through the term sheet and the loan agreement, but I think for a lot of these questions, the earlier you can front end them, the better, because they're going to impact things like the model, like the budget, like the schedule, all the things that are traditionally core towards any project financing. So moving on to the first topic is the timeline. One of the statements that was made yesterday in the committee meeting was that time is of the essence. So there's going to be a lot of pressure on the consultants, the commission, to get these projects executed on time in an efficient manner. Now, it was also very clear that it's important to get it right. Now, I mention this because, and I'm not going to go through the specifics of the application deadlines. Those are in the application materials. There's a 4 to 6 month due diligence process, loan execution shortly after that, targeted funding at some point in December. That's kind of the late stages. It could be accelerated depending on the project. But the point of this is there are hard deadlines. There's going to be pressure to meet those deadlines. Those hard deadlines should be viewed as such. If you don't meet them, You are subject to removal from the diligence process. It's certainly not automatic, though. But the important thing is going back to the nature of project financing and the general fluidity of it. I mean, models are moving up until oftentimes financial close. But getting out in front of those deadlines that may be problematic and having an open and direct and active communication line with the administrator as you go through those deadlines and that process and identifying them is an important and critical component of the due diligence process. We know KYCs, for example, coming up. The model submission is due in November. So to the extent you have issues submitting those, I would get out in front of that with the administrator during your weekly calls. On KYC, that was another topic brought up multiple times. We've seen the materials. It's a thorough list. It also is a bit open-ended. I think as an applicant, the way I would be thinking about KYC is it's kind of two groups. What individuals are signing the loan documents, both closing and moving forward? Who's putting their name behind the representations? Who's putting their name behind the covenants? Identifying those individuals as part of this initial process should be a priority, along with who are the individuals approving and authorizing the loan documents. The board members, any individual controlling shareholders. Those are the types that should be laid out front in your KYC materials. KYC also is going to be a bit of a fluid process. It can be difficult to identify who's signing a document 6-8 months in advance of it. But at least for the initial stages, I think the correct responses and what you should be focused on are identifying those individuals from an execution and an authorization standpoint. On the administration of the loan, so kind of going back to what John was talking about, like the DOE is set up to administer these loans. They've been around for a while. They have a loan administration team. That's not really the case, at least to my knowledge, with the PEC. So how is this loan going to be administered? What consultants will be involved? What is the process going to be, specifically in the context of draws and running the waterfall? Is it going to be more of a traditional construct of the draw is submitted and there's a third party, i.e. verification, whether it's, budget compliance, schedule compliance, COD, material permitting, that can vary, but whether that's going to be an objective criteria and the standard to draw on the loan, or is there going to be some sort of discretion for the commission to shut down the line at any point in the process? As an applicant, that is something I would want flushed out on the early end, including not only the draws, but also running the waterfall. The accounts bank, we know there's going to be an accounts bank. We know there's going to be a depository, but that's not a decision maker. What is the decision-making process for drawing on the line and running the waterfall once you're in operations? On the equity component, which we talked about earlier, so there is a question about whether or not it can be funded pro rata or lump sum. I think my expectation would be, given the tone of yesterday's meeting, that it would be a lump sum upfront payment due at execution, or not execution, but financial close of the loan. I think as you work through the process and as we work through the process and the process unfold, it's going to be important to the commission and the advisory committee that the investors have and the sponsors have skin in the game, so to speak. Is that set in stone? No. I mean, there's some language out there that implies it could be pro rata. I think it will be flushed out during the diligence process, but as a starting point, I would assume the equity contribution is a lump sum one made at closing. Based off the timeline, I don't expect that would have to be spent before access to the draws, but that's again a point that as you run your own due diligence on the loan terms, whether it's during or before the term sheet phase, that's something that should be flushed out as you look to access the loan amounts. On the performance covenants and the general loan terms, so some of the basic questions have been answered, but there are a number of open questions as well. These are just a handful of them. On the performance covenant that we talked about earlier, the key takeaway there is that it is very real and it is for 20 years. And I think the way you should think about that as an applicant on the performance covenant is if ERCOT gives you a directive to run, you need to be able to run. The project needs to be able to perform. Now, the question becomes, after the loan is paid off, what happens? While this is a long-term loan, the reality is it being outstanding for a full 20 years, it's probably not the likeliest of scenarios, but the covenant will be. So what is the impact of failing to meet that covenant? During the loan process, while the loan's outstanding, it's the traditional remedies, events of default. But post that world, into a world where you don't have the loan outstanding anymore, maybe you've refinanced it, what is the penalty for failure to meet that covenant? Is it a breach? Is it a breach of contract? Is it some sort of regulatory fines, liquidated damages, all or any of the above? That's a question we've had that I think will work itself out, or should work itself out, through the term sheet phase along with the loan agreement phase. On the financial covenants, this is also a bit of a moving target in terms of which financial covenants are going to apply. We've seen multiple ones. I expect a debt service one, obviously. I think the key here will be, as you work through the diligence process with the administrator and financial covenants are agreed, making sure they work your way into the model, making sure it works with a significant cushion, just the customary approach that you would have on project financing, but also addressing any builder or annualization components and what the expectations there. There's going to be a ramp-up period for all of these projects once they're in operations. And in terms of these performance covenants and the financial covenants, at what point are they kicking in? At what point are you annualizing or having some sort of building component once you're in operations? And I also wouldn't anticipate any of them falling away. I mean, I think once they're in, they're going to be in, given these are public funds. There is public trust. That was a point made yesterday during the advisory committee meeting. For the restricted payments and prepayments, I'll lump those together. And going back to what I just mentioned about these are taxpayer dollars. So there's going to be sensitivities around what to do or what a sponsor can do with distributable cash. My expectation here would be, I wouldn't anticipate some form of unlimited ability to RP out the distributable cash. I think as the process plays itself out, there's likely going to be some sort of component requiring some level of a cash sweep. To the extent there is distributable cash. Right now we've seen it's a bit open-ended, but going back to what I said on the due diligence being a two-way street, I would start to flush that out as early as you can when talking with the administrator on these calls. And I'd also anticipate modeling out what the sponsor returns are. The equity component here is a large component of it. And I think an expectation that there is some form of return at some point during the process is something that an investor should expect and should raise on the front end. The affiliate transactions component, so you're taking a step back, this component and this covenant is really designed to prevent a form of leakage, which there's going to be sensitivities around here as well, given these are taxpayer dollars. To the extent your project has and most of them, a lot of them will have some form of affiliated services, whether it's G&A services, whether it's vendor services, some level of operating services or supply. This is something I would also front end as part of the diligence process, if you haven't already, identifying where you do have those affiliated services that are going to be needed and provided. The focus will be, arm's length and the nature of those transactions, and the structure on how those reimbursements are made and how it's structured. I think that is also going back to earlier part of the, call it the open and direct and active communication with the administrator as you work through the due diligence process, because there's an indication that there may be affiliated transactions, but I can promise you if there are affiliated services, there will be regulations around that. Hedging is the last point that I'll touch on, and Winston touched on this earlier. From what we've seen and from what we read, hedging will not be in a traditional pari structure. It will be in a subordinated structure. To what extent that impacts your ability and to what extent that impacts your project is really going to be a project-specific question. Depending on who you ask in today's market, the traditional structure of hedging your natural gas supply, for example, isn't on people's radar like it was in the past. I think, in today's market with the demand that is kind of universally acknowledged, whether or not you need to hedge your supply is some people just don't think that's needs to be a part of this process. Now, if it was traditional financing, it wouldn't be, but this is not a traditional lender. But to the extent you anticipate the need to hedge, then it should be contemplated that there will be some form of either corporate guarantee or a credit sleeve product, something outside of the project asset securing those hedges on a parity basis. I think where this really is relevant is not necessarily in today's market, but it's more maybe 5 years down the road when this loan is still in place. The market dynamics change, and they can change quickly. And I think with hedging, and specifically commodity hedging traditionally being some form of parity structure, that could be a challenge at some point down the road. So getting out in front of that and understanding what your hedging needs are and making sure they're modeled appropriately is something that you should front end on your side. In terms of next steps and what you should be doing, I think at this stage, if you haven't already, ramping up your internal deal team, being proactive in these weekly calls, doing your own diligence on these loan terms. The topics I've talked about today, the topics that need to be flushed out through that term sheet and will be flushed out on the term sheet. Front-ending those as part of your own diligence process is something I think everyone should be considering, because it's going to impact the model that's due in November. It's going to impact your budget. It's going to impact your schedule. All in all, I think the more open and direct communication with the administrator and with the PUC is what is going to dictate really a successful project as you work through this process with them. You keeping in mind, you have one project, but there will have multiple ones. So being able to manage that timeline appropriately and being able to manage your needs as your project needs change will be critical to executing on your project. Thank you.
Well, thank you,
Winston,
gentlemen.
I'll turn it over back to you.
Perfect. Thank you, Mark and Mark, for your portions of the presentation. We do not have at this point any comments or questions, but can keep this open for another couple of minutes if folks have questions and wanted them addressed here. One thing that, while we wait to see if we have any other questions, one thing that Mark pointed out, and I think is really critical, is the lender here, the PUC, is also the regulator here. And so, understanding the policy lens through which the commission is viewing this program, its goals, the legislature who's overseeing this is absolutely critical in ways that perhaps, the DOE program as the lender, but with FERC as the actual regulator, and certainly various other state commissions, may not have had quite as tight of a convergence there as the PUC really has in this particular case. Any questions from the audience? Going once, going.
The only thing I would say, this is, there's no questions, but the advisory committee meeting yesterday, I think if you didn't see it, I would go back and spend some time watching it. I think there were some interesting topics discussed. It's a very interesting tone. I think it is very clear that the legislature is focused in on this project. They do view it as very critical. And while it's important to get it executed efficiently, it's also important to get it right. And so I think there's just, and going back to originally, we have a lot of answered questions, but there's still a lot of open-ended questions. But I think watching that committee meeting from yesterday, I would recommend it to anyone who hasn't seen it.
Yeah, absolutely. That's the TEF Advisory Committee, joint committee of a few members of both the Texas House and Texas Senate, available online. Well, okay, we do have one question. Addressing the process to get a second chance if the original application didn't get picked. So this is a great question. There is not as far as I'm aware, a defined process for that. Now, the commission received 72 different applications and advanced, now 16 projects to due diligence. There has only been, to my knowledge, one project that has been outright denied. The remaining, 55, 60 projects are sort of in the bullpen right now. And so it may be, and Mark alluded to this earlier, it may be that additional projects, especially if some in the current due diligence phase fall out for one reason or another, decide not to pursue the Energy Fund program, as is their right under the statute and the rule to withdraw at any time, then some of those other projects that are currently have a pending application, have not been affirmatively denied by the commission, may be called into the due diligence phase subsequently. I think an additional layer to that is you are, to Mark's point a second ago about watching the advisory committee meeting, we are absolutely sure that we will have large amounts of legislative input into this program when the regular legislative session actually kicks off in January. And so there may be, especially if there's additional funds coming to the Energy Fund, the governor and lieutenant governor had supported another $5 billion in the past couple of months, given the oversubscription to the program. You're likely to see some tweaks there on the legislative front that may help spell out what happens to these other projects that remain pending. So stay tuned for that. But as of now, for the projects that have not been affirmatively denied, you are technically still in the running. Alrighty, that's the only question we had. Again, let me remind folks, if you are interested, please join us on Tuesday, the 15th, from noon to 1 Central for our second presentation on Powering Texas, and that's related to obtaining and defending air quality permits, which obviously is another critical facet of all of these dispatchable power projects. So we thank you all for joining and look forward to seeing you again on Tuesday. Thank you.